Good morning, friends and fellow traders. This is Doug Campbell with Right Way Options, and this is the morning market preparation video for Friday, May 4th, 2018. For all of you Star Wars fans out there, may the 4th be with you. Hey, as as we're looking at this market, doggone it, I realize this is really a frustrating market. And if you're very frustrated, you are not alone. It's a challenging market to be sure. And unfortunately, I think there's probably a very high chance that our frustrations will continue through the better part of the summer. And let me explain that just a little bit. Well, first off, I wrote in the morning note this morning that the market price action is insipid, and insipid is defined as lack of vigor. And and by the way, if you've never read the morning note or would like to read the morning note, follow the link in the description below, and it'll always be there for every video. Insipid, meaning lack of vigor, is we get really good earnings reports, we get really strong economic data, and the market doesn't care. The bulls just cannot pick up any traction. There's no vigor. There's no excitement to move, and even though we are in a downtrend, we're seeing a lot of the days that we move down big intraday whipsaws, either intraday or the day after. And so we can't seem to, the bears can't even seem to really pick a direction and stick with it. We're lacking commitment on both sides. And that makes it very frustrating. And when we're whipping as much as we did yesterday was a nasty whipsaw. If we take a look at a 15-minute chart. Gapping down in the morning and then selling off down about 300 points, only to rally back up and basically end the day flat. After more than 600 points of travel, we ended up the day up just 5 points in the Dow. And as you can see here in the diamonds, we ended up basically flat on the day. So kind of frustrating, but there is some good news here. Now, the good news is if we take a look at the 200-day moving average, we ended up holding after failing it yesterday, and it was getting to the point that it was about to get really serious. We held on and rallied back and ended up holding the 50-day, or excuse me, that 200-day moving average on the Dow and the SPY. That's a good sign. And it's also a positive sign. We printed what candlestick folks will call a hammer pattern. That hammer, the way it's described in Japanese candlestick books, is hammering out a bottom. Now the bad news is, with the market not showing much vigor, and a hammer pattern requiring a follow-through to confirm that hammer as the bottom, we're looking at a futures this morning suggesting a slight gap down open. So we're looking to move lower by, at least at this point, somewhere around 40 to 50 points lower. Now that could certainly change because we have a lot of earnings, and we have the big employment situation number coming out here in a little bit. So let me just jump over there and let's take a look at that. On the economic calendar today, we have the employment situation number at 8:30 a.m. Eastern before the market opens, and that could certainly move the market around. Now, they're expecting in this number to be actually really strong, and luckily they're not showing, at least at this point, they're not expecting inflationary pressures or wage pressures to really be pushing hard on this number today. So it's possible we could get a really good number here that moves the market. They're expecting the unemployment rate to drop by 1/10 to 4.0%. I mean, we're talking full employment, what they consider full employment in basically historic kind of employment numbers here. So we're looking really good economy-wise, as long as we don't slip into that inflationary pressure that everyone seems to be tremendously worried about. I I lived through the days of I was young and in college, the Carter administration, when we had 20% interest rates. So to me, a 3% interest rate, or the threat of a 3% interest rate, is not exactly something to run for the hills, screaming that the world's coming to an end. But it is a concern, and I understand under our debt situation right now, any interest rate increase is a major concern. So let's take a look here on the earnings calendar. We have about 95 companies reporting earnings today. And next week is a massive week of earnings. About 1,400 or so companies are planned to report next week. So kind of keep that in mind. But after we get through next week, we have a couple more days of relatively large earnings, but then we really drop off in the earnings, and we're essentially completing the earnings season. So next week is the last really big week of this earnings season. So make sure you stay on your toes. Make sure you're checking those earnings reports if you're thinking of buying or you are holding a company that's about to report. You don't want those big, ugly earnings surprises. So where do we go from here? Well, what I'd like to see is some follow through. I'd like to see us move higher off of this area. The last thing I want to see is that we fail that 200-day moving average on the diamonds or the spiders. That would be ugly, and it's certainly possible looking at the current futures market. So kind of keep that in mind. We also want to remember that we're heading into a weekend, and the news right now seems just incessantly their desire is just to whip up and continue to spin out this whole trade war thing, and fears on that. They're just spinning and spinning and spinning it. So with that in mind and heading into the weekend, it may be a little bit tough where the bulls are really showing that lack of vigor anyway. It may be really tough for them to really grab a hold and push this market higher on a Friday, even if we have a really good employment situation report. So kind of keep that in mind and be a little bit cautious how you plan your day-to-day and how you plan your risk. Let's take a quick look at the VIX. The VIX yesterday spiked, broke that downtrend line, was really starting to become a worry where we really could have gotten ugly really fast. But then that rally came back, pushing us back down just below this support level, leaving a little bit of a shooting star type pattern here. That would be great if we could get follow through to the downside. But once again, it's not looking like that, at least at the open this morning. So we'll have to remain kind of cautious on that. Take a look at T21, 22. 4-week new high new low ratio, and you can see that slipped a little lower yesterday, but we've still got plenty of room to move down. We've got plenty of room to move up. So it's really difficult where we stand right now to make a true bull bear determination. I love hammer patterns just like anyone else. I want to see that hammer follow through, but that is an absolute requirement. It's not a hammer. It cannot be a hammer if we follow through to the downside. We need a follow through to the upside to confirm that bottom. And we actually, with the way the market is right now, we actually need that with some energy And so far, I'm really concerned that we're going to see that today. So be real careful, be cautious as you move forward into the weekend. Hey everyone, if this is the first time you've seen this information, please do me a favor. Click on that subscribe button on YouTube, the follow me button on Facebook, and click those thumbs up buttons. Drop comments on these videos if you feel they're worthy. And by the way, I really want to say thank you to everyone, all the subscribers and the folks that do take the time to comment. I really do appreciate it. You guys are awesome. Also feel free to share this video with any friends or family that you might think could benefit from this information. Everyone, I want to wish you a fantastic day. I want to wish you great profits, and I want to wish you an even better weekend. Hope everyone has an awesome weekend. Be safe. Have a great time. Relax. Rejuvenate. We'll see you back here bright and early Monday morning. Everyone, take care now.